Welcome to the deep dive. We take that fire hose of information out there and try to boil it down to what you really need to know. Today, we're diving into something pretty big happening in digital assets. We've got this new report from Henley and Partners, the wealth advisory firm, and it's showing this, frankly, an explosion in crypto millionaires, like a 40% jump year over year. It's huge. But here's the catch. The total number of crypto users, that only went up slightly. So how did the millionaire count just rocket up like that? Okay, let's unpack this. Our mission today. Figure out the real story behind that number. We think it has a lot to do with big money, institutional capital, finally jumping in. The report even says this might be maturing the market for real.
That's exactly right. We're definitely moving past that, the retail-driven Wild West idea. The report itself calls this a watershed year for institutional adoption. That phrasing is key. It suggests a fundamental shift, not just another price cycle. So yeah, our job is to kind of translate what that big institutional money actually means, what it looks like on the ground, because understanding that flow, it explains more than just prices. It explains why this new wealth is so concentrated.
Okay, let's start with those headline figures then, because the growth rate just year on year is pretty astonishing. Henley and Partners says the total number of crypto millionaires jumped 40% to over 240,000.
Yeah, the specific number is 241,700.
Right, 241,700. And this is all happening while the whole crypto market valuation pushed past, what, $3.3 trillion by the middle of this year, 2025?
Exactly. And that 40% growth, while impressive, it gets even more telling when you drill down into the really high wealth tiers. That's where you see the institutional footprint.
What do you mean? Like the super rich?
Precisely. Look at the centimillionaires. These are people holding over $100 million in crypto. Their numbers shot up 38% to 450 individuals.
Wow, okay.
And even higher up, the billionaires, their count jumped 29%. We're talking 36 crypto billionaires by the end of June. What's fascinating here is that rate of growth, especially at the top. When you see the number of people holding 9 or 10 figures in crypto jump by nearly 40%, well, that's not just random luck or retail traders hitting it big. That has the unmistakable signature of massive institutional funds moving in. Only they have the kind of capital to create centimillionaires and billionaires at that speed.
Okay, so that scale of money, it begs the question, why now? Why did Wall Street suddenly get comfortable? They were hesitant for years because of regulation uncertainty, right? The report points to policy actions, specifically mentions the Trump administration's crypto-friendly moves giving confidence. But what does crypto-friendly policy actually mean for, say, a big investment firm?
That's a really good question because it's often glossed over. For institutions, it boils down to certainty, mostly around custody, how they hold the asset safely, and classification what the asset is legally. The policy comfort came from signals that regulators wouldn't suddenly crack down hard, things like key officials saying, maybe implicitly or explicitly, that Bitcoin and Ether aren't securities. That lowered the perceived risk of huge enforcement actions against exchanges or custodians. It basically gave the big financial players the green light, or at least a much clearer yellow light, to build the infrastructure to hold billions securely. It de-risked the whole process.
So the policy kind of cleared the path, removed some roadblocks, but the actual vehicle delivering all that capital was the ETF, the exchange-traded fund.
Exactly. Perfect way to put it. Think of it like this. The arrival of these U.S.-based spot Bitcoin and Ether ETFs.
Yeah.
It's like they built massive new federally regulated highways straight into the crypto city.
Okay, I like that analogy. Highways.
Yeah. Before, institutional investors, they had to take these winding, complicated, sometimes legally murky back roads to get any exposure. Expensive, risky. Now, they have direct, compliant, easy access through products they already understand and trust. Regulated investment products.
And when you build a highway, people start using it. The traffic flows.
Oh, it flowed. All right, look at the numbers. Spot Bitcoin ETF inflows surged, went from about $37 billion up to over $60 billion. $60.6 billion, actually.
Huge jump.
And Ether, even more dramatic. The spot Ether ETF inflows quadrupled, went up 4 times to $13.4 billion. So this massive institutional adoption is acting like opening the floodgates on a giant reservoir of capital.
Ah, there's the floodgates metaphor.
Right. All this investment potential that was held back, dammed up by regulatory fear and complexity, it just surged into the market.
Yeah.
And that fundamentally changes things.
And we can see who's opening those floodgates, right? The report mentions specific players.
Yes, it does. Investment advisory firms, hedge fund managers, they were the big buyers, especially the spot ETFs in the second quarter.
So they're the ones driving this. But wait, if the money is getting so concentrated with these big players, Doesn't that make the market maybe more volatile or riskier for them too?
That's a fair point. Volatility is still definitely part of the crypto landscape. But for these large managers, the regulated access through ETFs drastically cuts down on operational risk, on compliance risk. For many of them, that reduction in operational headache outweighs the asset's inherent price swings. And the data shows they're comfortable making that trade-off. You saw investment advisory firms push their holdings to $1.35 billion, hedge funds up to nearly $700 million just in spot ETH ETFs in Q2. When the pros move in that aggressively, they're essentially accepting a volatility as the price of admission for potential big returns.
Okay, here's where it gets really interesting, I think. Looking at which assets drove this, the report says Bitcoin millionaires rose 70%. That's way faster than the overall 40% market growth we talked about.
Yeah, 70%,
Yeah.
significantly faster.
So does this mean Bitcoin's role is changing? Is it less about, peer-to-peer payments and more like digital gold, a reserve asset?
That's exactly what the data is pointing towards. Bitcoin's outperformance really highlights its perception as the most established, the foundational digital asset. We saw Bitcoin sent to millionaires jump 63% to 254. Bitcoin billionaires up 55% to 17. It's leading the charge. The report quotes Philip Bauman from Z22 Technologies, who notes Bitcoin is becoming the base currency for accumulating wealth.
Okay, base currency. Can you break that down simply for us, for listeners maybe not deep in finance jargon?
Absolutely. Think about how the global economy works.
Right.
A big multinational company might deal in euros, yen, whatever, but often everything gets valued back against the US dollar. The dollar is the reserve, the benchmark.
Got it, like the
standard
measuring stick.
Exactly. Bitcoin is starting to play a similar role, but within the digital asset world. For many sophisticated investors, it's becoming the main digital asset they use to measure the value of their entire crypto portfolio. Even if they hold lots of other tokens or coins, Bitcoin is the anchor, the trusted foundational layer for their strategy. That's why the big institutional money tends to land there first. It's seen as the most liquid, most secure digital reserve.
That makes sense. And it ties back to the concentration point you made earlier. We have 40% more millionaires, huge wealth creation, but the total number of people using crypto globally only nudged up 5% to about 590 million.
Right, and that gap between the 40% millionaire growth and the 5% user growth, that basically tells the whole story we've been discussing. This move isn't driven by millions of new, small retail investors getting rich. It's largely driven by big institutional capital flowing in, pushing up the value assets already held, often in large amounts. And this concentration of wealth, which is also highly mobile, brings us to the next point: the global competition to attract these wealthy crypto holders.
Yeah, Henley and Partners, since they advise wealthy clients on things like citizenship, they actually rank the best places for crypto migration based on factors like adoption, regulation, tech infrastructure, tax rules. The US, Singapore, and Hong Kong came out on top, followed by Switzerland and the UAE. Seems like places offering stability and good infrastructure.
Those are the established leaders, yes. But what's also really interesting is how smaller nations are trying to compete. They're getting creative, trying to lure these investors and their capital, often using things called regulatory sandboxes.
Okay, what exactly is a regulatory sandbox? Sounds a bit experimental.
It kind of is. Think of it like a controlled testing zone set up by regulators. It's a specific legal framework that lets companies try out new financial technologies, maybe a novel type of exchange or a complex DeFi product with lighter regulations or supervision for a set period.
Ah, okay, so it lets them innovate without facing the full weight of existing rules immediately.
Precisely. It lowers the risk for innovation and helps attract capital and talent that might otherwise shy away from stricter, more established financial centers. It's a way for smaller players to carve out a niche.
That's clever. So which smaller countries are really leaning into this to attract this mobile digital wealth?
We're seeing quite a few different approaches. El Salvador is obviously unique, making Bitcoin legal tender, offering tax breaks on crypto gains, trying those Bitcoin bonds. Then you have places like Uruguay, known for what's called a territorial tax system. Basically, if your income comes from outside Uruguay, you generally don't pay local income tax on it. Very attractive for mobile wealth.
Interesting.
Yeah, in Costa Rica, Panama, they're leveraging speed and relatively clear rules for setting up crypto businesses. Others like Greece, New Zealand, even Panama again, are using specialized visa programs, golden visas, essentially tied to investments in tech or property, specifically targeting this crypto wealth. It just shows how fast governments are trying to adapt to capture this capital flow.
So, wrapping up our deep dive here, the incredible wealth surge we've seen in crypto over the past year, it's less about a broad user boom and really a story about legitimization, isn't it? Building those regulatory highways like the ETFs, combined with clearer policy signals, that's what allowed the institutional floodgates to open. The market's maturing definitely, but the wealth is very, very concentrated.
Exactly. And if we connect this to the bigger picture, you see this emerging global competition for digital finance dominance. Now, given that the U.S. seems to be attracting both the big institutional highway builders dominating those ETF inflows, and it's ranking high as a destination for these mobile, wealthy crypto holders, it raises a really important question for you to think about. Is the U.S. positioning itself to become the default global hub for this new concentrated digital wealth? Could it potentially win this competition against other sophisticated players like Singapore or Switzerland in the long run? What would that mean for global finance and maybe even tax policies?
That's definitely something to chew on. A big thank you for joining us for this deep dive. If you enjoyed getting informed on this, please do follow, like, and share the deep dive. And you can follow What Bitcoin Taught Me pretty much everywhere: Twitter, X, Nostra, Blue Sky, Threads, Instagram, Facebook, LinkedIn. Find us there. We'll see you next time.